Yeah, you look at the issuance of all the stable coins, to Rafi's point, the issuance of stable coins would really compete with the Wall Street banks, would really start, in my mind, to challenge the mandate of the Fed, one of the mandates, and in the respect that when stable coins are being created, not just by banks, but by corporations, the backing will be U.S. treasuries and a one-to-one basis primarily, or real darn close to it, instead of currency being created through lending by the banks. And what this does is it will take reserves out of the Federal Reserve, because these bonds, these treasuries will be purchased or taken directly from the Fed or the accounts at the Fed, and then deposited into the Treasury General account. In other words, everything goes through the Fed, and so it will go through the Fed. It will pull reserves out and go into the Treasury General account. And really, what that does is it gets us probably much faster to that point that we saw in 2019, where you had about $3 trillion in reserves. And when you dip below that, you get into a liquidity problem. You get into that reverse repo problem. You get into the overnight lending spike problem. There are a lot of very interesting things happening at the Federal Reserve. The appointing of Stephen Murin to the spot that it has opened up, the gal that resigned. He's the gentleman who advocates for a weaker dollar, who wants lower interest rates, and is the author of the Mar-a-Lago Accord. So many things happening with the Federal Reserve, not to mention who is going to take the helm who to replace Powell next year. And is it Judy Shelton? Is it Bessent? What is their plan? Is it to devalue the dollar? Is it to do something with gold and revalue it? You just saw the Federal Reserve issue a report right off their website. Go to it and look at it, talking about gold revaluation, how it's been proposed by people not only in the United States, but other central banks around the world. What was a fringe theory that I talked with you and others about months ago is now all of a sudden being written about on the Federal Reserve's own website. Certain things that stick out as well. You have Michael Hartnett, who is an analyst at B of A, amazing analyst. You know, Vince Lancy covers him well, and Vince is another smart guy, one of the smartest. But Michael Hartnett is one of these guys you have to read over and over, or have Vince read it for you and kind of translate his lingo. But he just came out the other day and said central banks, in essence, will be forced to revalue their gold reserves because of debt burdens, which is obviously very positive for gold. Michael Hartnett said that. And then you have another one of their analysts, Bank of America, Francisco Blanche, talking about gold revaluation, said, be very bullish for gold, showing it's no longer a barbarous relic, but a key asset for central banks. Now even the biggest central bank of them all is taking a renewed interest in gold. So you have analysts of the B of A talking about this, but this is too hard for the Fed, I think, and the Treasury to ignore in an effort to pay down debt, to fund stimulus, or to infrastructure. Maybe not to issue as many bonds for a while because they'd have enough money in the Treasury General account, or, to your point, support a new currency framework, a new partial gold backing, or to Judy's point, a gold-backed treasury. And for those of us who say, well, like James Rickards, it's funny because I did an interview today, done again with Alistair and Jesse Day. Jesse asked Alistair and I on, and he doesn't think it'll happen, that gold will be revalued. And I said to him, I really appreciate your insight. I disagree. I say, when I'm on with Dunnigan, I tell him you're the smartest guy in the industry, and he is. But I do disagree. I do think that it's too hard to ignore the ability to softly default on the dollar by revaluing gold. It is one of our only options left. And for those of us who look past even being able to market, guys like James Rickards, who's saying way much higher, maybe 24,000 based upon a metric he has, or Mike Maloney, who says 10,000. 10,000 would give the Treasury General account $2.5 trillion free and clear. 24,000 would give $6 trillion free and clear. But I think politicians might argue, if it gets to that point, that the long-term purchasing power of gold justifies a higher valuation. I don't know, but I do think that it's coming. There's been a lot of talk also about the tariffs. One of the things that I saw last Thursday night, and again, I've never seen before in my going on 36 years in this industry. So I'm out to dinner with some people, one of which is someone who I work with, and he says, "Do you see futures? They're at $3,500." And I look at my phone, I look at our website, I'm like, that can't be because spot's 3,400. He says, "No, they're 3,500. I'm like, can't be. Lo and behold, I looked at the CME website, and yeah, they were at 3505 or whatever, even higher. I've never seen that to my memory, where on one announcement that the futures price dislocated by $100 an ounce from the current spot price, and certainly putting a 39% tariff on gold bars would have been enough to certainly do that.
It's extraordinary when you step back and just look at what's unfolding in real time. For decades, we've been told that gold was some barbarous relic, that it had no place in a modern financial system. But here we are, watching the Fed itself publishing papers on gold revaluation, Bank of America analysts saying central banks may have no choice but to reprice their reserves, and sovereign nations quietly buying physical metal like it's going out of style. If that doesn't tell you we've reached an inflection point, I don't know what will. Now, one of the things I've been talking about lately is stablecoins and what their explosive growth means for the system. Rafi pointed this out, and I think he's right. The issuance of stablecoins is more disruptive to Wall Street banks than most people realize. Why? Because when corporations or institutions issue dollar-backed stablecoins, they don't need to go through the normal lending channels. They're taking treasuries, parking them with custodians, and issuing digital dollars one-to-one against them. That means fewer reserves flowing through the traditional banking system. And here's the kicker: it siphons liquidity out of the Fed's own ecosystem. Think about that for a second. Normally, dollars are created through bank lending. But if a corporation can issue $1 billion in stablecoins backed by treasuries, that billion doesn't pass through a Wall Street bank. It bypasses the very mechanism the Fed uses to manage credit. And where do those treasuries come from? They're purchased right out of the Fed system, draining reserves and moving them into the Treasury General account. That accelerates the liquidity crunch we last saw in 2019, when repo rates spiked overnight because reserves dipped below $3 trillion. I've said before that the Fed is cornered. Well, stablecoins just shove them deeper into the corner. They can't outlaw them without undermining innovation and pushing it offshore. But they can't let them proliferate unchecked either, because it eats into their monopoly on money creation. It's a lose-lose situation. And then you look at the personnel changes at the Fed. Stephen Miran, the guy who wrote the so-called Marigo Accord, is stepping into a key role. He's openly advocated for a weaker dollar, lower rates, and essentially reflationary policies. If you ask me, that's not a coincidence. That's foreshadowing. It tells me that the path forward is not a Volcker-style tightening, but a controlled devaluation. And here's where gold comes in. When debt burdens are unpayable, governments have three choices: outright default, inflate it away, or revalue collateral. Gold is collateral, and revaluing it is the soft default. Instead of telling bondholders, sorry, we can't pay, you mark your gold reserves up 10-fold, 20-fold, and suddenly your balance sheet looks solvent again. It's accounting alchemy, but it works. And it's not just me saying this. Michael Hartnett at Bank of America, who is as sharp as they come, has said central banks may be forced to revalue their gold reserves. Francisco Blanche, another Buffet analyst, called gold no longer a relic, but a key central bank asset. When guys at one of the world's biggest banks are openly talking about revaluation, you know the Overton window has shifted. This isn't fringe anymore. It's mainstream. Now, some people say, Andy, come on, they'll never do that. Well, go read the Fed's own website. They've published research on gold revaluation. It's right there in black and white. They cite economists, other central banks, and the idea that raising the official price of gold could help pay down debt, fund stimulus, or backstop a new currency framework. What used to be conspiracy theory is now policy discussion. That should wake people up. Let's do some math. The U.S. officially holds about 260 million ounces of gold. At $2,500 an ounce, that's about $650 billion in value. Nice chunk of change, but it doesn't move the needle against $34 trillion in debt. Now reprice that gold at $10,000 an ounce. Suddenly you've got $2.6 trillion of value. At $24,000 an ounce, like Jim Rickards suggests, you're talking about over $6 trillion. That's free equity injected into the Treasury General account. That's how you pay for infrastructure, how you cover deficits without issuing new bonds, how you soft default without the headlines. And it's all perfectly legal because it's just a book entry. You think politicians won't be tempted by that? Come on. These are the same people who spend $2 trillion packages like you and I buy a cup of coffee. The ability to conjure trillions by revaluing gold is too seductive to ignore.
Less than 1% of contracts ever stood for delivery. Now, I used to say that way back when we started talking about all the deliveries on COMEX. In 2020, I was talking about this with you, and I'd say, look, forever, 1% or less stand for delivery. And I mentioned to you last week how just through the first 3 days, we saw 20,160 contracts post for first day settlement. And of those 20,160, which is 2,160,000 ounces, every single one of them stood for delivery, 100%. Now that's really unusual, like way unusual. And in 3 days, the first 3 days of the delivery notice, $7 billion worth of gold stood for delivery. And most has actually been withdrawn off of COMEX. Now I got at the same time, and I want to give credit, I try and always give credit to people like Vince Lancy and Alistair, because this whole community does so much work. And it's hard to do it all on your own, and I rely upon 3, 4, 5 hours a day of reading, and I find so many people, and I try to quote them. This is someone, I don't know who it is, but I noticed that we follow each other now on Twitter. His name is PM, his or her name, PM as in Precious Metals Bug. And PM Bug said, I looked at the totals for COMEX daily delivery stock reports for the last few days. You can see that the received and withdrawn numbers are 10 times the net change. Okay, I could show you the table. But what I want you to understand is that August 1st, must have been a Friday, August 4th, 5th, 6th, and 7th. Those are the days that are in this table. And what it shows as is that for silver, okay, for silver, the COMEX received 1,721,192.540 ounces in bars into the COMEX on those 5 days. 1,721,192.540. But we saw leave the COMEX withdrawn over those same 5 days, 1,890,316.820. So more than all of the silver that was deposited in those first 5 days, which in and of itself is crazy, seeing all of these deliveries, all of it plus another 170,000 ounces left the COMEX. One of the things that's really unusual, Dunnigan, is this acceleration. It's crazy enough to see the deliveries. It's really crazy to see the number of contracts posted for settlement stand for delivery when so many of these contracts would roll over or cash settle, not stand for delivery. And when you see in 3 days, $7 billion worth, 20,150 or 60 contracts, all of them stand for delivery, it should start to marinate in your brain that something much, much, much bigger here is happening. And look, so I mean, what you're basically seeing is that not only are players wanting to keep their metal at COMEX vaults or bring it here from wherever it's coming from, they're also withdrawing a massive amount. A massive, in fact, in this case, more than was delivered. To me, that is a massive sign of the times, and you have to wonder who's behind all of this. I don't know.
You know, when I talk about this with people, I often get the reaction, Andy, this all sounds too dramatic. Governments don't just flip a switch and change the rules overnight. And to that I say, have you not been paying attention the last 20 years? Look back. In 2008, banks were collapsing on a Friday and bailed out on Monday. In 2020, the world shut down in a week, and the Fed conjured trillions out of thin air in a month. Policy doesn't move in inches anymore. It moves in leaps because the system doesn't give them the luxury of slow adjustments. Now tariffs, let's connect this to gold. The announcement of a 39% tariff on gold bars caused futures to explode, dislocating $100 over spot. That's never happened in my career. You have to understand what tariffs do. They don't just raise the price of imports, They send a signal. The US is telling the world, we don't want your gold unless it's at a premium. Why? Maybe they want to hoard their own supply. Maybe they want to discourage foreign inflows to control domestic pricing. Or maybe, just maybe, it's part of a controlled system to bifurcate markets. One domestic, one international. That's exactly what BRICS is doing in reverse. They're saying, we don't want your dollars unless it's for oil or wheat or something real. But we'll happily settle in yuan, rupees, or rubles if you accept gold backing. You see the parallel? Both sides are weaponizing trade to reposition gold. The BRICS strategy is subtle but brilliant. They don't need to announce a gold-backed currency. They just need to keep settling bilateral trade in local currencies and use gold as the balancing asset. Russia sells oil to India, gets rupees, swaps excess rupees for gold on the Shanghai exchange. China buys copper from Brazil, pays in yuan. Brazil offloads yuan for gold in Dubai. Over time, gold becomes the neutral settlement layer. That's a gold standard in practice, without the official declaration. And guess what? It's already happening. Gold imports into the UAE have exploded. Switzerland's refineries are shipping bars east at record pace. India imported over 350 tons last year despite tariffs. China's central bank just announced its 22nd consecutive month of gold purchases. These aren't rumors, these are facts. Every month, metal leaves west to east. So what happens when enough of the world trades this way? The dollar loses its monopoly, and the US, faced with dwindling demand for its treasuries, will have to counter. That's where revaluation comes in. You can't fight a gold-linked system with an unanchored currency. You need to mark your gold higher to defend credibility. Now let's talk silver, because silver is the joker in the deck. Gold is the wealth asset, the central bank collateral. Silver is the workhorse, and silver is in structural deficit. Last year, the world consumed over 1.2 billion ounces against mine supply of around 820 million. That's a 380 million ounce gap, and it's not a one-off. The Silver Institute says we've had 3 consecutive years of deficits. Where's the extra metal coming from? Inventories. But inventories are finite. People don't realize how critical silver is. Over half of demand is industrial. Solar panels, EVs, 5G, medical tech. A solar panel uses 20 grams of silver. An EV uses up to 60 grams. Multiply that by millions of units. India alone is targeting 450 gigawatts of renewable energy by 2030. Do the math. That's billions of ounces of silver, yet mines can't keep up. Silver is mined primarily as a byproduct of copper, lead, and zinc. You can't just turn on silver production unless copper demand justifies it. That means supply growth is capped, so you've got rising industrial demand, falling inventories, capped supply, and at the same time investors are waking up to silver's monetary role. That's dynamite. Gold can double, triple, silver can go tenfold, and historically in bull runs, silver outperforms gold by a factor of 2 or 3. I'll give you an example. In 1971, when Nixon closed the gold window, silver was $1.50. By 1980, it hit $50. That's a 3,000% increase. Gold went from $35 to $850, a 2,300% increase. Both spectacular, but silver edged it out. In 2011, gold ran from $700 to $1,900, a 170% gain. Silver went from $9 to $50, a 450% gain. Again, silver outperformed. That's why I call it gold on steroids. Now here's the kicker. The gold to silver ratio right now is about 80 to 1. Historically, it averages around 15 to 1. If gold revalues to $10,000 and silver merely reverts to 1/30th of gold, you're talking $333 silver. If it reverts to 1/15th, you're at 666 silver. That's not fantasy, that's math. So when I say silver is the most undervalued asset on the planet, I mean it. It's not just undervalued against fiat, it's undervalued against gold, against industrial demand, against history. And when this reset comes, silver will move violently. Let's zoom out to the Fed again. Everyone keeps asking, will they cut rates? Wrong question. The right question is, How long can they keep rates where they are before something breaks? Debt service is already over $1 trillion annually. That's more than defense spending. That's more than Medicare. Every 1% rise in rates adds $300 billion to annual interest. You think that's sustainable? No chance. The Fed's caught in the classic debt trap. They can't raise rates without blowing up the treasury. They can't cut without killing the dollar. So they'll do what they always do: pretend, jawbone, kick the can. But the math doesn't lie. When your debt to GDP is 130% and rising, there are only two exits: inflation or default. And as I said, the soft default of revaluing gold is the politically palatable option. Now I want you to imagine the headlines. Federal Reserve announces gold revaluation to $10,000. Do you think CNBC is going to cheer? Number, they'll panic. They'll tell you it's inflationary, dangerous, crazy. But behind the scenes, every insider will be quietly relieved because it resets the board without collapsing the system. And here's where tariffs and trade wars tie in. You put tariffs on gold, you manipulate flows, you force foreigners to hold dollars longer. It's financial trench warfare. The BRICS push gold into settlement. The US puts toll booths on gold trade. Both sides maneuver, but in the end, the market decides. And the market is voting with physical flows. East wins, West loses. One of my favorite tweets last week said, "Watching the Fed manage debt is like watching a guy on a treadmill increase the incline in speed every minute, while telling reporters he's in control. You know how it ends." Exactly. The treadmill stops when the legs give out. So what do you do as an individual? You get off the treadmill before it flings you into the wall. You hold gold, you hold silver, you hold some assets outside the system. You don't wait for permission. You don't wait for Jim Cramer to bless it. You act when the writing's on the wall. And I'll tell you, the writing's not just on the wall. It's flashing in neon lights. Central banks bought over 1,000 tons of gold last year. That's the most since records began. Why would they do that if gold was obsolete? They know what's coming. They're front-running it. And you should too. In the end, history always rhymes. Empires overextend, currencies debase, gold returns. It happened to Rome. It happened to Britain. It's happening to us. The dollar had a great run, 80 years at the top, but no reserve currency lasts forever. And when the baton passes, those holding real money will be the ones left standing. So don't let anyone tell you this time is different. The names change, the technology changes, but the story is the same. Gold and silver are money. Everything else is credit. And when credit collapses, money shines. That's the message I'll leave you with. Protect yourself. Protect your family. Don't get caught in the complacency of the mainstream. Because when this reset hits, and it will, it won't wait for you to catch up.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.